Good evening, everybody. Kenneth Tortoise Capital Nightly Strategy Podcast for swing trades on the weekend, September 24th, 2022. Thanks to the fellas for contributing the slides tonight. This is just to announce that we're very close to publishing the pilot program on the applied system development process for traders. This is an expedited expert course on developing your own trading system around our building blocks using our approach to system design and adaptation, put together by a couple super traders from the Van Tharp Institute that have been my students for over a year. They've gone through all my courses, received personal coaching, and then developed the courseware that allows you to follow one of the traders as they apply all the techniques and develop the Kata 2 challenge system. This is a system that he's been trading all year, has not had a negative week yet this year. Trading one symbol, intraday only, with no overnight risk, with 4 standard patterns. And he's done a superb job in going through the step-by-step process of plan, prepare, execute, and assess to fully explain that system, how he developed it step by step, and showing the nuances of trading that system, in addition to the general practice of building your own system using these methods. So that's going to be the worked example of that system for intraday trading using the Brazilian ETF and the Dow Jones Industrial ETF or the futures. So this is actually a day trading system that's very suitable for intraday trading, either aggressively with Brazil or conservatively with the Dow 30 Industrials, and they've done a really nice job on that. So just to announce that that's coming. The pilot program for the first 20 people will be done at a deeply discounted price. So if you're interested in that and you're in the sound of my voice, send me a note at longke@yahoo. You know my email, and we'll get you on the list for the pilot program. That'll be at least a 50% discount to when we finally release the course after the pilot. But it looks really good right now already. This is the almost the halfway point on the Creativity 202 course. That was our initial rollout of that course, with weekly lessons from Angus Fletcher from Ohio State and weekly lessons from me, and then doing 2 90-minute office call sessions with the students in that course where they debrief their weekly learnings, and we share those in a true storytelling roundabout that has been providing some just unbelievable insights into psychology, creativity, trading, collaborative learning. It's extraordinary. By the time we're done with that version of the course, we will have had well over 100 hours of additional small group work and dialogue as part of what's already an exceptional course. So when we open that one up here in October, that's a phenomenal course, and you'll get a chance to go through the course, listen to their work, as well as have the option of doing facilitated group work yourself if you like what it is that you're hearing. So this is the one-page note sheet that I put together. That I do that for each one of the courses, because each one of the lessons in the course, because I take the course myself as I'm going through it, even though I've written half of it. Lesson 14 about seeking the exceptional featured some insights into the world of Saladin, the great Arab military leader, and his use of poetry to sustain his forces and his initiative, and to release his confidence and fighting spirit, and to inspire his armies. It was an exploration of what happens when you try to do a rules-based brain and battle against brains that are primed to respond with energetic intuition and alignment. Hint, the second one wins. Adaptation and using the natural power of the brain to adapt is the winning position. It was an exploration into the difference between signal and noise, and the importance of recognizing and then applying exceptional information from all your radar screens. It gave us some insights into how to find and understand the uniqueness of every person, which I found strongly resonant with the work of Dr. Gabor Mate of Vancouver and his discussion of the myth of normal. On my side of the equation, when you get into the trading exercises, there was a psychological thought experiment that explores what we mean by transformation. It exposes you to a formula, purpose times action times artifact, compared against the forces of the status quo, culture, inertia, and how does leadership and initiative and creativity tip the scale towards positive, affirmative transformation. And then this comes from the practical world of military leadership and executive coaching, when I challenge our new bosses in the college to demonstrate how their leadership with skin in the game is on the side of transformation when they're asking people to take risks. So that turns out to be a pretty powerful way in that formula to help you develop your own transformative energy when you're trying to make significant changes. So more goodness coming to us out of the Creativity 202 course. I'm really excited about getting into the case studies this weekend. You're going to see our master swing trader Ken H, who does this on the side as a side hustle. He's a business executive and is trading his own account, and has put together a consistent weekly approach to swing trading that's been very powerful this entire year in both directions, I might add. So when the year was going well, he was swing trading on the long side. When the year rolled over and started getting punitive, he was able to adapt nicely, and you're going to see some examples of that. His weekly uploads of charts give us a look into his ongoing open swing trades, as well as some trade frames that meet all of our standards for critical state trading, and I think you're going to enjoy this one. As usual, we're going to start off with a hat tip to Chi Wing Chong, who has given us the kind of the market status update here with the z-score of the slopes of various instruments. So what we're doing on this one is that we're taking a look at some key sectors in the S&P. So we're looking at the S&P itself, SPY, and then the energy, finance, materials, and tech sectors, which are important elements of SPY itself. XLK represents the technology engine that leads us forward into transformative heights when the market's going well, and sort of a measure of the optimistic spirit of growth and technology. And then the energy, finance, and basic material sectors tend to be cyclic in nature and are aligned with the business cycle, and they can go in and out of phase as rotational leaders, and so they behave in many ways different than technology and the market itself. And so by monitoring those five symbols, we're able to get a feel for the nature of the market. Now, what we do is we're going to take a look at the slope of the 30-period regression line. So a 30-period regression line simply is taking the last 30 bars and computing the straight line regression that best describes that price behavior. So then if you compare that to a flat zero line, the angle, call that theta, the angle tells you how strong that move has been. You obviously would prefer to be long symbols that have stronger slopes or short symbols that have um, negative slopes. Well, what we can do is we can go back 180 days and we can compute the value of that slope for each of those 180 days. And then we can find the strongest up, the weakest down. We can find the average, and then we can compute the standard deviation of that data, and then we can find the range of normal strength of that slope over the last 180 days. We can then compute a z-score, which is simply the number of standard deviations away from the average that it is. And that gives you a way to compare the strength of slopes of different instruments. And then when you plot that on this time series, you can now very quickly detect the phases of the market and the relative strength leaders and laggards as we go, and what the most recent trends happen to be. So we call that the slope stat, and it's one of our fundamental approaches to understanding relative strength and the state of the market and the current trend and how extreme it might be at any given time. It turns out that this is a fractal indicator, and it's one of our core statistical elements when we're analyzing markets in any time frame. We happen to be looking at daily charts here, daily time frames, because we care about swing trading in today's. Oops, sorry, I didn't mean to put that in there. Not sure what that is. Yep. All right, so let's, with that brief explanation out of the way, let's kind of get into it. And so what we notice here, the current situation, is that the zero line on the z-score is right here. And we notice that all of the market indexes and the sector indexes are below that zero line, meaning that the downward slope of price is well below average compared to the last 180 days. So this is a market that is noticeably weak, and all of the trends are down, so it's getting weaker by the day. And because almost all of them except energy have passed the critical -1 z-score, it is now becoming abnormally week. So we consider this range between 1 and -1 to be the range of normal, statistically speaking. So anytime you see something like tech and the S&P and materials and finance all below that critical -1 z-score, this tells you that all of those sectors and the market itself are failing and are so weak that it is abnormally noticeable how weak they are. And energy's not much better. It's approaching that -1 as well. Now, if we go back just about 30 days, you would have noticed that we had all of these sectors well above the zero line on the z-score, and finance, materials, tech, and the market itself all up near 2 standard deviations better than average. That's how strong that move off the bottom about 30 days ago really was. But since that time, it could not sustain, and now the steady decay of that price action has now produced a trend that is becoming alarmingly weak. This is a really handy way to figure out where you are in that price cycle. It sort of calibrates momentum. Like all of this strength here in XLK, the blue line, was coming at the same time that energy prices were being cut dramatically. After a strong run-up in energy, oil started to get slammed, and then that was favorable for the entire market, that when energy goes down, the market goes up because your cost of producing goods and services is way down, reduces your costs. And then that gets to something like a natural limit up around 2 sigma, and then that rollover started to show how first the market, then the leaders, and then even materials itself began to decay. There was no rebound at the zero line. In fact, it just started getting progressively worse, and now we're at -1, and we are on the border of real pain and suffering. And you'll notice that things can get really bad in a hurry if buyers don't come in and start hitting these prices. So right now, the fact that the S&P and tech are leading the way down is really bad, because that's the engine of change. That's the engine of growth that you hope. And when the engine of growth is in last place, that's really a disturbing phenomenon for the market. That is a lack of confidence in this market altogether. The second chart shows the same thing, only now what we're doing is we are comparing the S&P, again, which is right around minus 1.5, and we're comparing it to XLY, which is the consumer discretionary ETF sector, and then XLP, which is consumer staples. And this is also problematic because XLP should be those defensive companies that are mature, that are earning positive cash flow, and form the bedrock of normal economic life. And consumer discretionary features those companies that should do better when people are buying with discretionary income. And so when the S&P and the staples are both coming down here around -2, this is also an indication of some very fundamental weakness in the support structure of this market. In fact, XLY is doing relatively well only because Tesla and Home Depot, who are the two of the three biggest components of that ETF, are doing relatively well. So that's actually helping XLY. But this is really a problem, that the defensive sectors in the market itself are more than one standard deviation below average. Yeah, so Ken H. asks me, could we be using these regression lines like a moving average crossover system? Yeah, absolutely. Absolutely, yes. Now, in our RLCO framework, we're actually using the moving regression lines themselves. So when the 30 or when the RL10 cruises down and then reverses higher, and then it crosses the slower moving RL30, which we normally do in black, that represents the P1, or the famous regression line crossover. So the regression lines themselves act as moving average. They actually are moving averages. They are the least squares moving average. And so you can use the fast and the slow crossover at extreme conditions as a signal that maybe strong downtrends are starting to reverse up. What you get by looking at the z-scores is the ability to normalize the behavior of these different ETFs and see where they are in the cycle. So when you see things like this, when technology starts to weaken, it actually rolls over and pulls the market down with it, because as tech goes, it's often the leadership in the market, right? And so that became an important crossover in the same way that this became an important crossover on the other side. The technology began to roll up, and that began to drag the other sectors up with it. So yes, in the same way that we can look at moving average crossovers as a helpful way to identify turning points, you can actually use this and regression lines themselves as a way to do that. So this is problematic weakness here in the sectors. You can see yesterday's weekend report review for more details on different kinds of signals. Ken H. has done that and pulled out some things that he's tracking, and has selected from that report about a dozen charts of interest. So as you know, we have about 3 ways to identify our targets. That things that we look to trade forward are either continuation patterns, and that is, we were trading a pattern yesterday or last week, and the signal is still open, and it hasn't hit its stop yet. So we're ready to continue to trade that, or even add positions to it if conditions warrant. So continuation patterns are always on the table. And then anytime we get new signals from our swing trades, signal generators, we get new swing signals, then those become candidates for framing and trading. And then what we call the old reliables, and that is there is a set of symbols on our list that trade so well so often that we can use standard chart patterns on them regardless if they have a swing signal or not. And those are often the things that we're using for intraday hybrid trading and then growing those trades into the longer term swing trades. So we're going to see actually some of those, each one of those represented in the charts that Ken H has put together. We're going to start off with some continuation patterns that he has, excuse me, and then some new signals that he's framed up. And then there's a number of those are actually old reliable targets anyway that we track even if there's not a signal on them. Those are things like Brazil, the Dow, the Russell, our steel companies, and so forth. Okay, so let's take a look now at some trade frames. With again, grateful thanks to Ken H for doing the work. He's using the TC2000 bundle to help find and frame these charts. That's a very handy way to save time with a reliable trade framing robot that never gets tired and never makes mistakes. That's a pretty good guy to have on your team right there. So what we're looking at are the weekly, daily, and 65-minute, call it the hourly charts. So this is the way that we link together these fractal time frames so that we get an appreciation for what's happening at the higher time frames that might be affecting price action on the lower time frames. So we can see from the weekly that the price has gone below the critical state on the RL10, which was around 280. So this thing on a long-term basis is in free fall. This is the Qs, and that's a real problem. That's why the tech sector's 30-period regression line slope was so bad. You can see how the bottom has just fallen out of tech on the long term. We can see that on the daily charts and the hourly charts, Ken H has been trading this. He was getting 2 positions in and then cashing a win. 2 positions in, cashing the win on the pullback. A quick scratch and then a stop and reverse again. Second position with an exit. A quick short that didn't go anywhere, a re-entry, a second position, powerful capture, a quick scratch, stop and reverse, second position. He considered a third position, but because price was already so close to critical turning points, he felt confident just keeping the 2 positions on and managing. And now his stop is right here above 278 with price stuck down in here around 275. Now, if we take this last little trade sequence and bring it over into the hourly charts, you can see how he's using the hourly charts or the 65 minutes to get the PSAR flip trade on the supported spring crossing. When that works, he gets a COTA 2 second position. Now, this one was looking good until there was a big gap down, and so he gets out of it here with a stop and reverse. This one was a fractional loss, and this gain here more than paid for that one. Now, the stop and reverse works. I want you to notice how it held a little bit of support here at the last place it supported. When that breaks, he gets the collapsing dragon entry, and that is crushing this move to the downside. So he's probably holding 7 or 8 R. Now, this is where we considered adding that third position. That was this one. But he elected not to do it, and now he's just enjoying this move, and he's brought the stop for both of these positions down to 278, so he has about a $3 buffer. Now, if this breaks below 272, then he is authorized to go ahead and put a third position on because he has so much market's money in hand. That's how you do it, trading the great big index. And that 65-minute chart is like a very, very slow day trade, or it's a fast swing trade. That's actually hybrid trading in a nutshell, and so very nicely done. This one is in Twitter, another one of our old reliables. This one is simply setting up as a trade frame. He notices that the weekly has did a PSAR flip right here and is now stuck right in the middle of this triangle. So he's framing this as a critical straight ready to break large in either direction. You can see it even more clearly on the daily chart where you have a clear RL10 at 45, a peak of the RL10 at 45, belly at 38, and this is stuck right in the middle. So when it breaks out of this box, he's going to be prepared to go long and go test 45, or get short at 41 and go test 38. So he has a favorable reward to risk ratio trade in both directions. So he doesn't have to have a directional bias. He doesn't want one. That'll just get in the way. So if the hourly breakout happens from this box and then clears all of this at 42.50, this thing is long and gone until it gets up to 45, which is up in here. So he's got some clear resistance to break through. That's his tactical trade. So if this breaks out and he gets long right there, if it starts to roll over, he cashes a fractional win. But if it gets through, he could look at adding a second position because there's not any resistance until it gets up around this area, around 44.50. So he could trade that one strong in both directions. Similarly, this is strong support here in this channel. And so if this breaks down, he wants to be short. Now, he's got a second position indicated around 39.85, but I would say is if it breaks below this, that is a gap, and that thing is going to drop like a rock, and you'll want to put a second position on at 40.50 in my view. But that's a great looking trade frame on an old reliable. This is what we call the fence sitter. Now Twitter has the feature of not having sold off like the rest of tech last week. This is actually fairly stable right here, waiting for Elon to buy it, I suppose. So whereas tech itself got crushed, this thing was stabilizing. So the argument would be, if we see some strength in technology and it reverses up next week, that little boost could help Twitter, which is in the tech sector, and then the move to the upside could really be powerful. So that's a good looking frame, and we'll be ready for that one next week. This is Nucor Steel, one of our steel companies. He has been just crushing this one. Here was a supported spring crossing. He couldn't get it right in here until after the gap. So he takes it here. It's not too late. He runs this thing up here. It clears some resistance. He gets the second position on just in time to scratch that and then cash this win for about 1, 2, 3, almost 4R. Now, what we have next is a low, a lower, we have a high, a higher low. Come on, Ken, speak English. We have a high, a lower high, another lower high, a PSAR flip, and when this RL10 support level is broken, he gets the entry here, a second position the next day here, and he's riding this thing down, and now it's right at a support level around 105, where the last time it was here, there was a strong upward move. So what he's content with is having two positions in with a risk box of about $2, and he's holding about 10R in hand on the combination of those two positions with a nice tight stop here at 108, and ready to add another position if it breaks through 104, but ready to cash about a 10R win if it hits reverses at 108. So the steel companies trade like tech companies. They don't know any different. That's really a nice looking trade, and it's not over yet. This one is Apple. I'm sorry, Alcoa, another one of our metals, and this has very similar trade qualities. You notice how on the weekly, these lower highs and lower lows are just showing weakness, and this one has already broken below the weekly dragon at 45, so that's this weakness right in here around 45, and he traded this successfully on the long side up and then on the short side down, and he's got two positions in on this one. Oh, I'm sorry, one position. Here was the first short. It started to reverse, so he cashes that win and makes bank on that move. And then when this breaks, Not able to get this one until it broke again, and now he's short from about 39 with a stop right around 37. So he's well in the money. Now, if this breaks, you want to add another position to the downside because it's already well below daily support levels and the weekly support levels around 35. So this thing, if it breaks through 35, the next support level is down around 20. So that could be the beginning of a major assassination. So we like that one. Good looking trade on one of our old reliables. This is Devon Energy. Crushing this one also. Good scratch. This was a supported spring crossing on the hourly, and that's what it looks like on the daily. He gets one position, second position, third position, which scratches, but made great big bank on that trade. That's a trade from 57 to 72 on about a $2 risk, and this is a 7R win on this one. This is about a 2 to 3R win on this one. That's about 10R just on that swing trade. This was a quick scratch, stop, and reverse. He considered the second position, but he's holding one with about a $2 risk because you go to the top of the dragon, so there's a standard risk box. He considered this one, but just decided to work with it because it was getting close to support, and he didn't want extra risk over the weekend. And now this thing is down at 57. So here, just notice he went from 57 to 72 on the long side, earned 10R, and now he's short from 70 all the way back down to 57. The market is symmetrical. So the move from 70 to 57 is 13 bucks divided by a $2 risk. He's holding about 6.5R in hand, and then he can add a second position with market's money if that collapses. Because again, if this breaks, look out below all the way to 52. Yeah, so this is Ford got murdered on a $1 billion profit warning. That was the gap. Now, it did fight its way back up to the top of that last daily bar, but he's short with a couple in hand with a nice stop here at 1250. So he's well in the money. If this falls below 12, he can add a third position because this is going to move fast down here to 11 and a quarter. So that's a good looking short on industrial and old reliable. Nicely played. And you can see from what I want you to see also on this one. This is a Godzilla trade because it's pushing the bottom of the 5-day, 10-day, 30-day, and 150-day lows, and is very volatile. That's Godzilla all day long. One of our standard sniper patterns. This one is International Paper. Came from a Godzilla setup on the daily, and when this broke at 40, we started piling on. This is his swing trade most recently from short to 34. This collapsing dragon rollover. IP is not one that is easy to trade intraday. There's not a lot of intraday volatility, and it's really better suited for the kind of daily trades that you see here because it's such a mature company. The day traders haven't found it yet, but that just sort of makes it reliable as a swing trade. So this one's in good shape. He's got an R in hand and is well in the money, and that shows more signs of pain and suffering because, as you can see, there's no support over here anywhere. This thing can fall as far as it wants. There's nothing necessarily there to hold it back. This is NVAC. So this is so good. What he does on this one is he was looking at our sector analysis, found that XBI, which is the biotech, was the worst of all sectors. And then by opening that up in TC2000 bundle, you can see the individual components of that ETF. And he found that NDAX was the worst performer of XBI. And so while we could have gotten this move short here or here, he's content to get this one on this big gap down and failing. This is when it really became apparent. So he's short from 24 with about a $2 stop, and it's at 21. So he's holding 1.5 R in hand, and this thing is comfortably failing. And this is at such a low level, there's no support anywhere. This thing has fallen from 230 to 21. That's minus 90%. They may not be long for this world. So this is an opportunity to pick over that carcass and manage the trade. This is Caterpillar, great industrial company, but like everything else in the industrials with this economic slowdown, this collapsing dragon short on the weekly around 173. This is that move at 173. When that collapses, the bottom just falls out. So we pay very particular attention to that collapsing dragon. Now what he's got here is a trade frame because it has fallen and had a little bit of recovery, so you have just enough potential belief that you could get a 1, 2, 3R move back to the midpoint around 173 of the 5-day range. So there's a 3-to-1 just on a tactical bounce. But if this fails through 162, you'd have no compunction getting short because we have left behind all of the weekly and the daily support levels. So that's a great frame in both directions. Home Depot has been suffering, and you can see the same idea of the strong upward move, the mirror image downward move, holding support at a crucial price level here. So you wouldn't be surprised to see that 2-day support level hold and then give us a zero state breakout all the way back to 282. So that's a $12 move to the upside to get back to this resistance level on about a $2 risk. That would give you a 6-to-1 reward to risk ratio on the way up. And if that fails, then it will have failed at a critical state, and there is no weekly support over here at all to hold it up. So Caterpillar, along with all the other industrials, is in position to get smoked. This is Johnson & Johnson. Now, the healthcare has been relatively better as a sector, and you can see that there has been kind of a choppy but certainly slightly upward trend to this thing. He's prepared to take that on a breakout to the upside or to the downside where it could come back to 161. If this breaks out above 170, you could add a second position here, but otherwise he's got a 2-to-1 reward to risk to the upside. This is one, I think there's better ones, but this on a relative basis might be an opportunity to think about acquiring some Johnson & Johnson for a much longer holding period. That'll be the last pharmaceutical to go out of business, I think. Yeah, so this is one that might be worth a longer term look back. Just on the weekly basis, what you could see is a Kata 2 formation. So on a weekly basis with about an $8 risk, you could see how if you add $16 now to 168, you could see this getting to 184, which is the top of the price stack. So you would get a 2-to-1 reward to risk ratio if you were, say, going to manage that on a weekly basis and using a wide stop, which is about a 5% stop. That's not an unreasonable position for a long-term orientation. This is DBMF, a managed futures strategy, and this looks a little thinly traded to get this on a daily, but or on the hourly. But I could see how you could continue to trade that to the upside because it has exceeded the previous peak, and the weekly is at an all-time high. So this thing is ready to go. I would have no compunction about getting on that one. And the same management skill that got that kind of returns during a harsh sell-off Nothing wrong with that. That one looks like a pretty good find to me. That looks like a fireworks style sniper trade. So well done. This is Starbucks. Notice the harsh sell-off in Starbucks on the weekly found support finally. There's the PSAR flip weekly. That's where that weekly trade is possible, like $80 with a $6 risk. That's like the one we just showed in Caterpillar, where you're getting that upward price action and some higher lows on the weekly. So this is showing a sign of healing, and you could see how price could get to 100 from 94. So there's still a $6 upside to this thing, and you have an opportunity to buy it on this recent sell-off to 83. Now, what I would prefer is the short side move back to this support level, and if that breaks down to this support level, so I would want to add a second position here and then a third position there if those price levels did not hold. This was an earnings warning, and that if this support level breaks, look out below. I do like the rebound opportunity if that turns out to have been an overreaction. So you have a very small risk on the hourly and an opportunity for a large trade in either direction, and that's best practice. This is Credit Suisse, and boy, the bottom just fell out of that altogether. Holy smokes. That weekly support level just got crushed right here, and nothing to hold this up whatsoever. This was the indicated short on the collapsing dragon. We could already be short. Now it's held support at the bottom of this on Friday. So that's either an overreaction. This whole big sell-off from 5 to 4 is an overreaction, and then it'll bounce and close this gap, or it's going to continue to fail miserably. Take your pick. But that's one that's going to move fast, and I would look at that as an intraday primarily for a quick hit. Finally, our last one is Rivian, and going along with Tesla's weakness, it has pulled all the way back to this support level. The move up could not be sustained. It's back to the same level where it has held support previously and featured two strong moves from this support level. Now, from this support level, it's also had a strong downward move, so that's what makes this a ball game. Is it going to do this or going to do that? The least likely thing would be to go sideways. So by putting that tight bracket with about a 50-cent risk, you could be easily persuaded to go short with a target of about 31, or long with a target of 36, and you have at least 3-1 in either direction on Rivian, which has proven to be a really volatile, excellent intraday trader and a pretty good swing trader as well. So that's certainly one that's on our list. It does feel like on a longer term basis it has found support, so you might think of that as a way to start getting a position into electric vehicles as an alternative to Tesla at some point. All right, so that's everything we got for today. Well done, fellas. We'll get this published and posted in the usual way. Again, if you're interested in the Applied System Development course and the Kata 2 Challenge, to be in on the pilot, let me know, and I'll send you some price information and get you signed up. And just a note, in October we're getting ready to start firing up the new quarter of courses for the Tharp Institute. That'll be the last chance you get to start the creativity course in a small group until January. It's always possible to take that course at your own pace at any time and still have access to all of the recorded true storytelling sessions, and those are well worth the price of admission themselves. So, but if you want a group facilitated start, then you kind of have to go with the cohort that starts in October or wait for the one that happens in January. Special cases I would tolerate. If you brought a group of people together that wanted to start off cycle, I would probably support that as well. So that's everything I want to cover tonight. Take good care, and we shall see you tomorrow morning for the Creativity 202 guys from Europe, and Monday night for the U.S. session, and then tomorrow night we'll have some more master classes on trading at the usual 8:30 time. So take good care, and we'll see you tomorrow. Thanks a lot, Ken H.